So, what is an exit? Simply put, an exit is selling your business to cash out and get the financial reward for all the value that you've created. The full definition of an exit is the sale or transfer of ownership of a company through a merger, acquisition, or buyout. Acquisition is what we'll be focusing on, to another buyer or investor. And in M&A terms, an exit isn't simply cashing out. It's a structured transaction that allows you to exchange your ownership for value. And what do you receive in an exit? You receive a cash payment, or it could be hybrid. It could be a cash payment. It could be also equity in the acquiring company. It could be a combination. It could be earnouts, seller finance. It could be multiple things put together to kind of create an offer that is suitable for the seller. The type of form depends on your goals, the business size, and the buyer type. And what are the most common types of exits? The first, of course, is acquisition, where the buyer purchases the company or its assets outright. The second is a merger, where two companies combine operations into a new entity, or into an existing entity. Management buyout, which is where your team or your employees buy the company outright from you. And acquihire, where your whole team gets acquired. Okay, we see a lot of those now these days with AI and all those kind of companies. Or liquidation, which is the least preferred type of way to get an exit, and that's usually through a business shutdown or debt resolution. So those are kind of the main five. And now there are two core deal structures that you'll see in an acquisition. The first being an asset sale, and you can kind of look at this as like buying a car. Let's say, for example, an asset sale is when you decide to buy the tires and, for example, the windows of the car. And a share sale is like buying the full car with all of its problems, if it has any. So those are kind of the two differences put in simple. But an asset sale, it's the most common for smaller deals under 10 million, and it's when you're buying assets of the entity. Okay, and it's the most easiest structure to perform when you're selling a business or buying a business, and it's cleaner, and there are more tax implications for sellers, but overall it's what's usually preferred. In a share sale, share sale is usually when you're doing larger deals above 10 million. It's simpler. You just buy the whole entity, and the buyer assumes all existing obligations, and it's often more favorable for tax treatment, okay, for the sellers. And here's kind of what that looks like in this diagram. The buyer can pick specific assets. It's cleaner. And then for a share sale, the buyer acquires the entire company, and the buyer assumes all obligations. Now, the M&A market landscape, what are the brackets? What does it kind of look like? So there's the micro markets. It's anything under 1 million. And usually who's buying this is, individual buyers who have some money set aside, first-time acquirers. A lot of times you'll see SBA loans being used for this, or some sort of financing to acquire the business. It's when usually someone is looking to get into the industry of acquiring businesses. And then we also see the lower market, and this can also be individuals as well, serial entrepreneurs or very small private equity firms, which you can call micro private equity firms. And the next up is lower middle markets. This can be search funds, family offices, private equity firms as well. And then we go to middle market, which is 50 million to 500 million, which is private equity firms, strategic acquirers. This is where you see the most common acquisitions happen. And then there's the upper middle / mega, which is 500 mil plus, and it's large private equity firms, public companies buying other companies, and so forth. And what does the exit journey kind of look like? So, there's the preparation of materials, making sure the company looks good for buyer scrutiny, because buyers will tear apart your company and kind of make sure there are no dead bodies hiding and things like that. So you got to make sure that you're prepared for it. Then there's the valuation, making sure that you're coming up with a good number that's attractive to buyers and that you're not either shooting up too high or too low. And then there's the buyer outreach. It's finding the buyers or having the buyers reach out to you depending on the strategy that you use. And then finally, once you do find a buyer, you get into negotiations on the deal structure, the payments, the price, things like that. And then once you agree on a price, you get into due diligence, where the buyer will go into your data room, look at all the documents in there, and they determine for themselves whether it's something that they want to acquire. And then there's closing. If you sign the LOI, you sign the asset purchase agreements, you get into closing. The escrow account is open where the funds are dispersed, and you finalize the legal documents, the transfer of all assets, you receive the payments, and completely transition the business. And why do founders choose to exit? So we have to kind of understand the motivation behind it, because there's a few different motivations of why somebody would exit. And the first would be market timing. Sometimes it's really good market to exit. And for example, like we saw during COVID, there was a lot of dry powder, a lot of companies who had cash and they were looking to acquire businesses. So that could have been a good time to exit. And we did see for our own firms that was a great time to sell a business and for buyers to buy a business. Cash was really moving hands quickly. Another could be risk mitigation. Let's say, for example, you have a few businesses that you're running. You want to kind of cash your chips and you want to put some money in your pocket. That could be a good way to do it. Of course, the biggest one is cash out, which is just to get paid for the work that you've been doing for many years. And then there's also burnout relief. And this one looks like it's not finished. But yeah, you might be burnt out from running the business for years and you just want to cash out. So at the table, there's also reasons why buyers buy. And there could be a few reasons, which could be strategic expansion and market entry. So for example, let's say you're in the beauty industry and you're selling makeup brushes, something like that, and you want to expand into foundation or something like that. And you can expand into that market by acquiring a business who's already selling that. Another could be synergies and cost savings. So for example, let's say you have two businesses who are running individually, and combining them could ultimately, you could bring one team together, they'll run the business, you could save money there. You could bring your subscriptions together, save money there. There could be a lot of different ways to save money. Another could be talent or IP acquisition, and this could be acquiring another team or acquiring IP of a business. And we see this a lot with AI companies right now. OpenAI acquiring a bunch of companies, Google acquiring companies, Apple acquiring companies. And there could also be another reason, which is platform roll-ups. So for example, you have aggregators or funds who acquire multiple businesses to create a larger, more dominant platform, which in turn they exit for a much larger sum in the future. And then it could also be for financial returns, which is probably the most common, and what private equity firms do. They acquire a business for cheap, or they try to acquire it for a good price, and then they try to scale it up for a few years and then ultimately exit it for a higher amount in the future. When is a good time to exit? So timing your exit correctly is really important for maximizing value. Okay, and the ideal moment often arises when you don't need to sell, but it allows you to negotiate from a position of strength. Okay, and when is a good time? So the first is when you're mentally prepared, you're ready for transition, and you have other goals. The second could be strong financials. So let's say you've already had 12 months of history or a few years of history of stable or growing revenue. That's a good time to exit. Clean operations, of course, this is really important to make sure that the business is sellable. So make sure that you have your books aligned, you have all your SOPs made, the team is running the business instead of you running the business by yourself, and also a clear growth story. So it has to be a compelling narrative for future growth potential, or if you have active inbound buyer interest from buyers. Why is preparation important? Preparation allows you to get higher multiples. So you could see 30 to 80% higher valuations, and buyers really appreciate when a business is tidy and when it looks good. And clean books, proper documentation, and a good narrative will do this. And the journey to becoming buyer ready is what we will explore next in the next module. So it's going to be how to value your business, and the deal math.